Implied volatility remains elevated, which can be fantastic for option premium sellers. When volatility is high, option premiums rise. Implied volatility percentile is a good way to see if the current level of implied volatility for a stock is high or low compared to the last 12 months. And 4 percentile of 100% means the current level of implied volatility is the highest it has been in the last 12 months. And 4 percentile of 0% means the current level of implied volatility is the lowest it has been in the last 12 months. When 4 ranks is high, it can be a good idea to look at option selling strategies such as naked puts, bull put spreads, bear call spreads and iron condors. Let's take a look at some large cap stocks within 4 percentile above 70%. The parameters for this screener are 4 percentile above 70%. Market cap above 40B. Most recent earnings date, between November 1st and December 20th. Total options volume greater than 20,000. The above list of stocks gives us a starting point to do some more research on with a view to selling options. Let's go over to the Naked Put Screener and see what that shows us. Naked Put Screener. Here we have the results from the Naked Put Screener. We can see stocks such as mRNA, BABA, ABNB, F, SQ, AMD, NVDA, and NFLX. The parameters for this screener are as follows. I customized these slightly from the Barkhart default preferences. Potential annualized return, 15% to 35%. Market cap above 40 billion. Days to expiration 15 to 45. Last trade time within the last 2 sessions. Security type equals stock and ETF. Option volume greater than 250. Open interest greater than 500. Moneyness minus 15% to minus 5%. Bid price greater than 0.50. One way to take ownership of a stock for less than the current price is via an option strategy called a cash secured put. A cash secured put is a slightly less bullish trade than buying the stock. It is considered a neutral to slightly bullish trade. A cash secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium or be assigned and acquire the stock below the current price. Selling put options is an easy place for investors to start with options. They are like a covered call and are pretty easy to understand once you know the basics. Traders selling puts should understand that they may be assigned 100 shares at the strike price. Naked put example. Let's use the Ford naked put as an example. A trader selling the January 18.50 strike put would receive $54 into their account, which would be theirs to keep. If Ford stock falls below 18.50 by January 21st, they would be required to buy 100 shares at 18.50. The effective net cost of the position would be 17.96, thanks to the option premium received. That is 9.19% below yesterday's closing price. If the stock stays above 18.50 at expiry, the put expires worthless, leaving the trader with a 3% return on capital at risk. That works out to be 35.4% annualized. The main risk with the trade is similar to outright stock ownership. If the stock falls quickly, the trade will suffer a loss. However, the premium received will help to offset the loss. The maximum loss on the trade would occur if Ford fell to $0, which would see the trade lose $1,796, but most traders would cut losses long before then. Cash secured puts are a great way to generate a return on strong stocks, potentially without ever having to take ownership. If the put does get assigned, the investor takes ownership with a reduced cost base and can potentially begin selling covered calls to generate additional income from the position. However, they can be risky and are not recommended for beginners. Beginners may prefer to trade a spread such as a bull put spread. Bull put credit spread screener. To execute a bull put spread, an investor would sell a naked put and then buy a further out of the money put to create a spread. A bull put spread is considered less risky than a naked put, because the losses are capped thanks to the bought put. Some big name stocks appear consistently throughout this screener. Let's use the first Tsla trade as an example. This trade involves selling the January 810 put and buying the 790 put. The maximum profit is $3.25 per spread, with $16.75 being the maximum potential loss, for a potential 19.4% return. The break-even price is 806.75 and the spread has a roughly 83.1% probability of success. Barkart's naked put and bull put credit spread screeners can be a great way to find option trade ideas.